Hello, ladies and gentlemen, and welcome back to part 3 of my interview with Max Arment, who is the co-founder and Chief Product Officer at Taulia. Today we are going to be looking at supply chain financing and dynamic discounting and the agenda of banks, and also how Taulia works with banks, and really what the opportunities are and what the issues are, the challenges are for banks working in this space. So Max, let's kick off with what you believe the bank's overall agenda is in supply chain financing.
Sure. So as I mentioned before, supply chain finance, traditional supply chain finance is actually pretty successful. So they're like for banks. There are 2,000 projects out there with corporates where the banks go ahead and offer early payments to the top 100, top 200 suppliers of those large corporations. But this is a little bit where the banks stop, right? They stop at the top 100, top 200 suppliers because, as we discussed before, they have certain regulations, requirements, KYC, know your customer, onboarding costs. And this makes it virtually impossible for a bank to go into the long tail or in the mid-sector of suppliers. So that's why banks focus to the top 100 suppliers. And this is where the perfect cooperation comes into place between companies like Taulia and banks, where actually the bank brings in the supply chain finance offering for those top suppliers, and a company like Taulia is offering a dynamic discounting, a buyer-funded dynamic discounting possibly for the mid-level suppliers and the long tail of suppliers. And in addition then, a company like Taulia brings in all those operational benefits, those surrounding features, I want to call it for a moment, e-invoicing, supplier self-services, and all that good stuff into the mix, so that then really you have a complete solution that a corporation can offer to the entire supplier base, and not only for a slice of the suppliers and not only one feature of being paid early. So this is what we see, and this is why we work with companies like Citi. That is why we work with a variety of hedge funds in that space. We will have another announcement later this month with one of the top 5 global banks, a European bank, where we work together in supply chain finance as well as in the e-invoicing space.
So people either have their own money, or if they need to use the financial reserves of a bank, they can partner with Taulia regardless.
That is correct. So it's actually a hybrid solution, a mix and match if you want. So you can even start financing all your suppliers with your own cash, and then you see probably that your larger suppliers are not receptive to dynamic discounting because it might be not attractive enough. So you might want to bring in then a supply chain finance program for those larger suppliers, which is more affordable and cheaper for the suppliers. Or another situation that we see is that a company starts actually with offering dynamic discounting, but for whatever reason, there are either business cycles where they want to hold on to their cash, or there's an acquisition that happens and they want to hold on to their cash. So we see all that. But still those suppliers that actually enjoyed already the early payment offers, well, you can't take that away. You still want to offer to those suppliers earlier payments. This is then when a funder, a bank, a financial institution can jump in and actually fill that gap that had been created by the missing early payments from the buyer. So we see great opportunities working together, and we do that already on many accounts, and it works just brilliantly.
Mm-hmm. So if an organization has significant cash reserves, and let's just say that they're not getting ready to make an acquisition, so they won't be utilizing that cash to grow their company through acquisition, is there any benefit in them using a bank to do supply chain financing rather than using their own funds to do dynamic discounting?
Yeah, there is. First of all, if they have their own funds, still the larger suppliers, the Intels of the world, that are often large suppliers, or the IBMs, the Accentures, for them, the offer that a dynamic discounting solution provides, the APR, even if it's the lower end, 4, 5, 6%, is still too high for them. And 4, 5, 6%, this is actually the weighted average cost of capital for a buying organization. It could be 10, it could be whatever, but let's get low with 4 or 5%. So that's the lowest that a buying organization typically wants to offer their own cash for early payments for dynamic discounting. And this still might, for many suppliers, specifically for larger ones, still too expensive because they have access to cash in a cheaper way. So for those suppliers, bringing in a bank and do a traditional supply chain finance program where then it's a LIBOR plus 50 basis points that the bank can offer to the very same supplier is actually very reasonable. And at the same time, there's a working capital gain for the buying organization by potentially, not necessarily, but potentially pushing out the payment terms for those suppliers. So there is still reason to do supply chain finance, absolutely. And obviously, some companies are more DPO sensitive than others. DPO, days payable outstanding. So if DPO is of a concern, then such a mix that I just described, using third-party cash, is certainly something that makes sense. And I want to mention one thing. I mean, while banks are, due to the nature of being a bank, are very regulated and limited to the top suppliers, the larger suppliers of a buying organization, other financial institutions, including hedge funds, are just way more flexible, and we together with hedge funds can be way more creative in actually providing third-party funding through a hedge fund to actually all the suppliers into the long tail. So with the advantage of being DPO neutral, if this is an important criteria for you as a buying organization.
How do banks perceive Taulia? Are you an organization that they proactively want to be working with? Do they see you as a natural partner, or do they see you as a natural competitor?
I think historically, because dynamic discounting and supply chain finance were perceived as competing initiatives, I think many banks used to see Taulia or companies like Taulia as competing solutions, as competitors. That changed. I mean, we made clear, and the market made clear, that the coexistence of a supply chain finance solution, a traditional one, and the dynamic discounting project is the right thing to do. That's why companies like Citi and others approached us and working together with us on many clients today. Can I say that all banks are convinced that there is no competition? Probably not. I'm sure there's still some banks out there in certain regions where Taulia is perceived as a competitor, but I'd be assured it's not. A hybrid solution of supply chain finance, this is where the bank plays, and dynamic discounting is a smart and right way of doing it.
Mm-hmm. And supply chain financing as a service that banks offer, how critical is it to banks that they put a focus on this? And are they actually putting enough time and energy and importance into the supply chain financing part of their offering to their customers?
Yeah. So I think it's, and I'm a hard time speaking for the banks because I'm not a banker, but I mean, the fact that every major bank has an offering in the supply chain finance market, the fact that I know that it is very competitive pricing-wise, supply chain finance, I know that from working with several banks, shows me that banks have a high interest in making that successful. The fact that it's around for 10 years and there are 2,000 supply chain finance projects on this planet actually shows me that there is a huge and incredible market for the banks. So I think it is important, and banks would love to explore, and actually do it together, explore ways of expanding the traditional supply chain finance offering, expanding it to a broader supplier base. And this is another thing that we at Taulia think will happen in the next couple of years, that banks, financial institutions will figure out ways to broaden the offering of supply chain finance, of funding suppliers, broadening it and extending it to a larger base of the supply chain.
Max Arment, co-founder and chief product officer at Taulia, many thanks indeed. Please join us next week when I'll be talking to Max in our part 4, our last part in this series, and we'll be talking about the future proofing of supply chain financing and dynamic discounting. So join me then. Thank you and goodbye.